Good morning, ladies and gentlemen. This is Butch Shorak, Options University. It's Monday, July 1st, 2013. Welcome to Market Forecast. Access to this video is for educational and informational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotional recommendation, solicitation, or offer of any particular investment, security, or transaction. Options University provides educational services that are meant to teach you the risks and rewards of trading stocks and options, and we're not a service that tells you what to trade. We're not implying or guaranteeing any profit, and as always, do not trade with money that you cannot afford to lose. Well, as we ended the second quarter of the year, we found that the quarter was up, and it was a positive quarter, and the bulls like that. But as we looked at the last month of the quarter, we look at June, it actually was a down month, and we finally had some kind of correction that took place. And when we look at the past week, we looked at the Dow, the NASDAQ, the S&P 500, the Russell 2000, and we do see finally positive numbers coming out of those indexes, and we see ranges anywhere from 0.7% in the Dow, 1.4% in the NASDAQ and the Russell 2000, and 0.9% up in the S&P 500. Looking at year to date, we see nice positive numbers. Dow up 13.8%. NASDAQ up 12.7%, S&P up 12.6%, Russell up 2,000. Any of you holding mutual funds have to be pleased so far with your returns during this coming year. And so let's take a look and see exactly what kind of economic announcements we have coming for the next week. All right, looking at those economic announcements, we look at Monday, July 1st. By the way, this is the 4th of July week, and we'll end up with a short week in the overall market. Looking at PMI on Monday, looking at ISM, and looking at construction spending, all taking place on the first day, July 1st, 2013. As we go to the Tuesday, July 2nd, we see that those of interest could be factory orders, which take place at 10 o'clock on Tuesday. Looking at Wednesday, we see that we've got ADP coming out, which is a monthly report. We have ISM, non-manufacturing index, coming out at 10 o'clock. And then, of course, all of us are going to celebrate Independence Day on July 4th with no market being open whatsoever. And then on Friday, July 5th, which will be a very low volume day with a lot of the big boys being out on Long Island and the Hamptons for their 4-day holiday, we'll see the employment situation take place at 8:30. Jobless claims taking place at 8:30. Normally these are on Thursday, but due to the holiday, these will come out on Friday morning at 8:30. All right, so when we look at the jobless numbers, we certainly have seen a decrease in unemployment taking place in the United States. If we look at Europe and we look at some of our other foreign countries, we find that they're at in Europe basically at all-time highs for unemployment. We look at Italy up about the unemployment sitting at about 12.2%. So all is not so rosy as we look around the world. But in the United States, our numbers keep improving as far as our employment numbers. Let's take a look at the SPX and see what it did and what its trend is. So looking at the SPX on a longer-term basis, we know that we have definitely been in an uptrend. And that uptrend has been quite consistent until we got to this area right here where we had our pullback. Our high took place in May, and we ended up with a pullback taking place in late May, early June. And we see that we dipped down to basically right around 15.55, somewhere in that range, which took place during the last week. And we saw that we finally are looking at anywhere from a sideways trend to one might even consider this the potential for a downtrend. So trend currently is a sideways with a slight downward move. We ended up with a lower high this week. So again, supporting this sideways range. Could this be the possible range for the rest of the summer? And we'll see. This has been a strong bullish market. Remember the numbers we went through when we talked about year to date, where we were talking about 15%, 12% up for the year. That's a whole year's move, and here we are only at the beginning of July. So, how much more oomph is left in the market, and are we going to get some kind of summer pullback? These are the answers that Wall Street will answer for us as we go forward. And for those of you that are short-term traders, these are the answers that you have to be careful of as you place your positions. Looking at a shorter term chart on the same SPX, we see that we reached our low on Monday, and then we had a nice relief rally take place. But notice we have a 30-day moving average, which is starting to dip down. We have a 50-day moving average, which acted as a pure resistance in this bounce. And we saw that Friday we had a pullback and changed this up cycle to a down cycle. So we're in a bit of a down cycle in this, what may very well end up being a sideways trend for the summer. We'll see. Are we going to return to those highs that we saw earlier in May? It's just a matter of watching this carefully. Watch your trend. The trend has weakened. There's no question about that. We would expect it to do so. And remember, this is not exactly the strongest quarter coming up of the year in general. This is the summer quarter. They call it the summer doldrums for a reason. So our strongest time of the year, strongest 6 months of the year start in October and go through the end of March and into May. All right, so now let's take a look at the Dow Jones, and we'll look and see what the Dow Jones average looks like during the same time period. And we see that again on Monday we had our low. Notice none of these approached that 200-day moving average, nor did the SPX. And then we had our nice little relief rally. This one also stopped and stymied by that 50-day moving average, as we see the 50-day and the 30-day getting closer together. Dow didn't have the big spread on the 30 and 50 that we saw in the SPX. Looking at the NASDAQ, our leader for the year, that and the Russell both up about the same amount. We see that we had on the NASDAQ again the same type of thing, did not approach that 200-day moving average. 50-day average acted as resistance in our relief rally. NASDAQ looked stronger on Friday than the other markets did as far as the S&P and the Dow, so it could give us a hint as to where we're going during this holiday shortened week coming up. And finally, looking at the Russell, again another one of our leaders for the year, we saw that we bottomed out on Monday and it too followed that same pattern. But look at this, 30-day moving average sitting here, strong relative strength out of the Russell, and it still ended up with a higher high and a higher low on Friday. So when we talk about our cycle, this Russell is still in an up cycle. Did not give us a lower high and lower low to change our cycle in the Russell. Many times the Russell is a forerunner for where the overall markets are going, so this provides us some thought of continued strength as we go into this 4th of July week. Looking at the VIX, of course, we got our spike that we were talking about in earlier weeks, and that spike took place. We got up around that 22 level, and we see that it has pulled back now and has shown getting back into our more normal levels. Well, it isn't quite there. Remember, our normal level is basically somewhere between 15 and 12, which is where it's been running if we look at the past year. Now let's take a look at some of our sectors to see by looking at sector ETFs to find out what our sectors have done during this time in the market where we've basically lost a bit of our uptrend. So with that thought in mind, let's first look at the bond market. And what do we see in the bond market is we see a bearish market. This thing has pulled back and back and back, and even as the market, overall markets, our equity markets were going up, notice that this thing was in still a dive. We should have seen a reversal on that, and we really didn't get much of one. So well below the 30-day moving average, the 50-day moving average, and we did get some kind of support out of that 200-day moving average. But if you've been in the bonds, it's been of a bearish time for you. Looking at TLT, our ETF for bonds. Maybe time for a bounce for that, but that certainly may not take place until we see some kind of rise in interest rates. And now we'll talk about next that safety haven that many people flee to when there's fear in the market, gold. And boy, we're going to see that gold down, basically some of the funds down 20% for the year, as we see gold down around 115, a long way from that $1,800 an ounce that we had earlier last year. So gold showing us much weakness and in real low levels for the year. Next, let's take a look and see what kind of volume we had in the overall markets during this last week as we had our bounce. And notice our bounce, we had huge volume during our pullback, and now during our relief rally, the volume came back to what one would call normal levels. This rally has not taken place with big volume, and notice it mimics the SPX, so we see that we did get a change in cycle. So looking again at this a potential sideways move out of the market for potentially the rest of the summer, as we again are up that huge up 15% for the year in many of our indexes. All right, next let's take a look at our ETF for financials. That is the XLF, and see exactly what that did during this time, as it gives us a kind of a summary of what our banks are doing, the XLF Spider Fund, and we see that it has showed strong relative strength to the SPX, as it didn't get stopped by that 50-day moving average, traded up to the 30-day moving average. Again, this indication that we may end up with a bit of a sideways move out of the market, as the financials showed good relative strength to the overall market, which according to some prognosticators will tell us that shows us that this rally may not be over. Next, let's take a look at oil and see what oil has done, and looking at USO, our ETF for oil, and we see that it's had a nice little bounce, headed for highs for the last 3 months. Not quite there, but showed good strength even as the market pulled back, and then had its bounce. This bounce has continued. It's still in an upcycle. Strong relative strength the overall market, as there's the 30-day moving average. This is well above the 30-day moving average, as oil had a nice pop during the last week. So that kind of looks at what the sectors look like and the indexes look like for the last week, which was the last week of June and the close of the second quarter of 2013. And for those of you that are gold members, stick around. We'll take a look at our stocks to watch. We'll take a look at some of our horsemen and see what they did during this what one might call a relief rally. And for the rest of you, we want to send out our appreciation for your being here. If you'd like to see more free videos from Options University, go to www.optionsuniversity.com/free gold. And with that thought, thank you for being here. This is Butch Shorak, Options University. This is Market Forecast on Monday, July 1st, 2013, the beginning of the third quarter, and a holiday-shortened week with the 4th of July. Thanks for being here.